It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
On this special question and answer edition of the Wise Money Show, we're answering your questions from a variety of financial topics like catch-up contributions and investing in individual stocks. We've got that and a lot more on this hour of the Wise Money Show.
Yeah, that's right. We love getting engagement from you and hearing questions, and we get a lot of that. So bring it on. Let's go. We'd love to hear from you. If you have any questions, have any needs, you can reach out to us a few different ways. Call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us and submit questions that way as well. And then a lot of questions come on the YouTube channel or wherever you're at in social media. Just reach out to us there. Search The Wise Money Show. I feel like it's pretty easy to poke fun of all of the tax law changes. I mean, it's like laugh or cry because it impacts all of us. And yet, remember, about a decade ago, when it was said that we'd be able to do our taxes on a postcard. Mm-hmm.
It's gotten steadily more complicated
we
ever
are
since.
Nowhere near that.
No.
We are light years away. And so this question we got from a recent show that we did about the new catch-up contribution rules. This fabulous question, although like on the surface, if you're an oldster and you're familiar with catch-up contributions, you might say, well, that's strange, but actually it's like right in line with some of the recent tax law changes. Here's the question. It was a call-in from Jim. Appreciate you reaching out. In your podcast about catch-up contributions, you mentioned at what age you can start them, but you don't mention the maximum age that you can do them. Is there an age when you're no longer able to do catch-up contributions?
What a great question.
It is. Okay, So let's start. Level playing field. What's a catch-up contribution? And how does it work?
A catch-up contribution or a super catch-up contribution?
Catch-up contribution.
Well, so you have to understand that these rules apply to your contributions to retirement accounts. So it could be at work if you have a 401k, or maybe you're a teacher or work in a hospital, so you have something similar called a 403b. This could be, you just contributing to your IRA or your Roth IRA. Everyone is allowed to contribute to these accounts, and there are limits set each year. Those go steadily higher. Right now, here in 2025, you're allowed to contribute $23,500 to that retirement plan at work until you reach age 50.
Yep.
And at age 50, they actually give you an even bigger bucket that you can contribute to. So you're allowed to increase your contributions. And the idea is that, as the name would suggest, that a lot of people need some time or the opportunity to catch up on contributions they wish they had been able to do when they were younger. And so this larger bucket or this larger contribution is a way for you to stuff even more money into your retirement accounts after age 50 and right up until retirement or whenever you stop contributing.
And so that's the 401k, 403b. Your catch-up contribution $7,500 for an IRA, traditional IRA or Roth IRA. Your catch-up contribution's $1,000. But they start the year you turn age 50. You're allowed to do this extra, and they never stop. I mean,
right.
you're one of the requirements in order to make contributions to a traditional IRA, Roth IRA, as well as your retirement plan. You have to be working. Right? You've got to have earned income. Mm-hmm. But that catch-up contribution it turns on, your ability starts at age 50, and it never stops. However, there is now there's a second tier of catch-up contribution, and this has been dubbed the super catch-up contribution, and that is when you turn age 60, you can do a higher amount. And this is, we've been getting this confusion as well from folks. Well, does that mean I can do the normal catch-up contribution plus this super catch-up? No, you get the higher of the two. And so at age 60, you can do $11,250 to your IRA or to your 401k, 403b, that sort of thing, not to your IRA or Roth IRA. This super catch-up only applies to those workplace retirement plans. Right now, that calculation is $11,250. It's actually a percentage of the normal catch-up contribution. So you can do that starting at age 60. But there is a maximum age limit for this one.
This is so bizarre. I have no idea why they put this in place. But it's
Agreed.
only 4 years, right?
60, 61, 62, and 63. Hey, what's special about 63 or maybe turning 64? Is that an important...
It is if that's your age right now, I guess. But
There is nothing significant about that, other than if that's your age right now, then happy birthday to you or whatever. but there's no other material significance to, well, but when you turn 64, everything changes. No, nothing changes. But for whatever reason, that's when this super catch-up goes away. And so what happened after that? That age limit at 64, you drop back down to the normal catch-up limits, which is 7,500. Makes no sense.
yeah, and that can stay there for as long as you keep on working.
Yeah.
There's not an age limit on contributions to these retirement accounts. If you're still working for your employer at 80 years old, you can contribute to that employer's retirement plan and not only do the maximum normal contribution, but also the normal catch-up contribution since you're over age 63 at that point.
All right. Now, you think that's odd. Hopefully that made sense. A couple other oddities when it comes to catch-up contributions. The first is, Josh, you said the catch-up contributions apply to retirement accounts, and that's true. And we would want to convince you that your health savings account is a retirement account. Please take us up on that, because that's you really optimizing your financial situation. But yes, HSAs, health savings accounts, they have a catch-up contribution as well. And so you would think, well, they're just going to follow the same rules, and that would start at age 50, right? Wrong. Catch-up contributions for your HSA start at age 55. Makes no sense. And if you have a family high-deductible health plan, qualifying high-deductible health plan, you can each do a catch-up starting at age 55. It's $1,000, but you have to make those to your respective HSA plans. I believe they're changing that rule and allowing you to still or just combine those contributions, making them to one. I'm not sure exactly when that's official. I know it's been kicked around. So that's one of the oddities. The other one is starting next year in 2026, your catch-up contribution, if you make over a certain amount of money,
$145,000
has to go to the Roth side of your 401k. Now, there's some really, strange rules with this. If you make over $145,000, yeah, but it's just your earned income from that employer in the prior year. So if you switch jobs and your salary is $200,000, but you only made $50,000 from them last year, then you're fine. Mm-hmm. You can choose your catch-up contribution to be pre-tax or Roth. But if you make more than $145,000 from that employer last year, then the next year, starting in 2026, contribution needs to be Roth.
It reminds me of a client who actually had two different employers, and she made about $100,000 at each of them. So she's well above the $145,000 threshold, but not with either employer, so she wouldn't run into this problem.
Right.
So just keep that in mind. And again, it's just on your catch-up contribution having to be now Roth contribution. And if your employer for some reason doesn't have a Roth feature on their plan, then you could actually be blocked from even doing a catch-up contribution, right?
I was going to do drum roll, because that, again, doesn't make any sense. But yet it's not just you wouldn't be able to do it. No one at the company can do a catch-up contribution. Can I just state for the record, this makes absolutely no sense. Like, catch-up contributions, and again, like, that's where we started this great question from Jim. Like, hey, if you're an oldster, seasoned financial veteran, and you might say, a catch-up contribution, those are easy. Listen to how easy this was. Not at all. Wildly complicated. But here's the thing. All of this complication means you have more choice, right? As much as I want to gripe about this new super catch-up and these rules, okay, I'll take it, actually. For 4 years, for a bizarre 4 years, you're allowed to contribute a little bit more. All right, sign me up. This weird extra $1,000 to an HSA when you turn 55, but not 50. Yeah, strange. Okay, sign me up. Mm-hmm. That's fine. And if for whatever reason, you're going to be required to make your catch-up contribution go Roth, that's still better than not doing a catch-up contribution, right?
Yeah. The problem is if you are at all responsible, this stuff hangs in the back of your mind because I'm thinking, okay, it's not long until I'm 60 and I can start, but I have to remember to start to do the super catch-up contribution. Mm-hmm. And then do I need to remember
to turn it off?
Right. Or will the plan actually catch it? So all these rules that have been made are difficult to administer.
That's why you need a Sherpa. That's why you need a guide, someone that's helping you with all 6 areas of your financial life. All right, we've got more coming up here on The Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is The Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning, also on podcast at the same time as well. So check it out there, but also on a couple of local radio stations here in northern Indiana, southern Michigan. They call it Michiana. And that's why the content's broken up and structured the way that it is. We've got a commercial break right now for the radio. But if you're looking for more content, helping you take your next wise step in your financial life, we've got videos that air all throughout the work week right here on this channel. Well over 1,500 videos that are all there for your benefit. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. And if you like the content, and leave questions below as well. We will answer them. Thank you. All right, no bonus content question this one, but we will have it at the second and third breaks.
So what happens is these plans get restated periodically to catch up with all of the regulations, but I'm searching for, is a plan required to allow Roth contributions?
No.
It must not be, because that's why they created, put teeth in this idea of if you don't, then no one can do the contribution. That was what was playing over in my mind. Like, why didn't they just make that a requirement?
Yeah.
But then they would have everybody restating their plans at the same time. And I don't know if that would, I don't know.
But that's not a huge deal.
It's not?
No.
It's, last I saw, it was 90-some% of plans have the Roth, but I mean, it's got to be 100% by the end of this year. And it's think. Not, but
yeah.
All right, let's get into the next question here. The Tesla and Palantir one. That's good. All right, second segment. Here we go.
So, and the only thing that I didn't say in the last segment was, what are the things that cause you to pay attention to your financial life? And these certain ages cause you to, but it doesn't. I mean, should I be looking forward to turning 60?
Yeah.
It beats the alternative.
Yeah.
Maybe not.
I don't know. I don't know. I want to hang on to my 50s, almost like I'm trying to hang on to my 20s. It feels like.
Yeah, right.
Newsflash, Kevin, when you turn 60, your brain will still tell you that you're 20 and you'll still be the same. So, yeah. So, look forward to it.
Well, that's
encouraging.
Oh, yeah.
My brain stopped. I'm in my mid-40s now, and my brain still says, oh, yeah, you're 23.
Yeah.
It stopped. I don't even know why.
Yeah.
Maybe God will explain it to us someday, but
I don't know.
I mean, I watch these athletes right now. So we're recording this October. So the greatest day in baseball of the year was just recently. All 4 games of the divisional series were on at the same night. No one had been eliminated yet. And so they were all playing. It's the best baseball. And I look at these men out there, and I'm certain that they're older than me. All of them. They look like giants. They've got facial hair. They can throw a ball 100 miles an hour, hit the ball 106 miles an hour. And I'm like, yeah, that's a grown man. Nope. They could be my kid.
Yeah.
All of them, just about all of them. What are the kids pitching for the Yankees? I will not say his name because it sounds like a really bad name, bad word. But he's 22, 21, 22.
And he literally could be your kid.
Yeah, he really good. And I look and it's he's older than me. I don't know why my brain is like that. So at 60, Kevin, that's what I'm trying to say. At 60, I'm certain my brain's still going to tell me that I'm 23. And these athletes are
funny.
older than I am. All right, here we go. Did you look up his name?
No.
Okay. Don't.
No, I know.
And definitely don't say it here because if you get tongue twisted, that'd be a foul.
Mm-hmm.
Here we go. Should you invest your 401k into individual stocks? And I mean speculative. Just take it all and put all your chips on red and just see how it goes. We got a question that we're answering right now from a fan of the show. That and more. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at. We are there as well. Search the Wise Money Show. This question came from Arthur on the Facebook channel. Fantastic question. Oh my goodness, is this one rich? And I'm certain you have wondered at least part of this question yourself. Here's what Arthur asked. I have a fairly small amount of money in my 401k. Can someone explain to me why I shouldn't just take it out early, paying the taxes and penalty, and put it all into Tesla and Palantir? Those are individual stocks if you're not a techie or a stock junkie. That's an unbelievable question with several layers. You guys know we make it look easy to take a simple question and make it very, very complicated. But I would say before we get into whether you should or not, would you need to take it out of your 401k and pay the taxes and penalty in order to do this? Say you wanted to invest in an individual stock. I'm saying, Arthur, you might not need to take it out of your 401k. You could either...
Because you're referencing possibly a feature that could exist on your retirement plan at work. If you do a little investigating, maybe it hasn't been promoted a whole lot. Maybe you've never had a reason or a desire to use it before, but it's possible that you could have a brokerage option attached to your retirement plan. A brokerage link is what it's often referred to as, but it's basically a way for you to set up a type of an account where you can buy and sell, you can trade inside of this account, just like any other brokerage account that you could go set up with one of the major investment houses independently.
Yep.
And that just opens up a whole new window of options. It effectively means about anything on the planet is available to you all of a sudden. Whereas you may be thinking, I don't have this much flexibility. I don't have many choices. Because inside of your 401k, it is more common to have a limited lineup of mutual funds to select from that your employer and the advisor serving that plan have picked to just make available as the roster of choices for you to select from.
And you'll see why here in a second, because there was a ton. In the aftermath of 08 and 09, there was a ton of finger pointing at plan sponsors and retirement plan providers saying, I lost all this money. You should have had safer investments for me. And when we explained the volatility here of Tesla and Palantir specifically, there's just no way that those individually will be options for you to invest in within your normal lineup of your 401k, unless you work at one of those companies. But you could see if there's a brokerage window or brokerage link. Another option, you could see if your plan allows for in-service withdrawals or in-service rollovers that would allow you to just keep working, but transfer your 401k to an IRA. So there are options. And if this was an old 401k or a prior employer, you could just roll it over to an IRA. And so you might not need to cash it in if this is what you wanted to do, or if it was a wise choice. You might not need to cash it in. The other thing that I would pick on before we answer, not pick on, but just address before we answer, should you do this, is my guess is that I have a fairly small amount of money in my 401k is a contributing factor to this. Because if it's a small amount and I withdraw it, then the taxes will be small, the penalty will be small, and the risk of loss will be small, but the gain could be substantial. Almost like I could gamble with this money. And if I lose it, it's okay. We would strongly encourage every dollar matters. Every dollar matters. And it's very possible as you build up your portfolio, it's okay to have some play money. I think that's okay. We don't know any other details about your financial life, Arthur. So if this is a small amount and it's play money, but you've got the rest of your retirement goals, you're on track with all your other dollars, it may make sense. But if you are just getting started and you haven't built up sort of your war chest and your financial foundation, and you're thinking, well, I don't have much saved up, so if I have to start over because this gamble doesn't work, I'm okay with that. I would encourage you, no, focus on building that foundation as opposed to hoping you've got a lottery ticket.
Yeah, retirement plan providers, especially the folks on the back end, because we serve at Korhorn Financial Group, we serve a ton of companies with their retirement plans. And when you talk to the folks about plan design, they are very hesitant to even allow in the plan design a brokerage window because there are so many horror stories. And if you think about it as an employer, do you want to allow a brokerage window in your retirement plan? And it's kind of tricky because you say, well, listen, I don't want to be big brother. I'm not your mother. I don't want to be in charge of how people do stuff. And I'm into freedom. So I'd want people to have the freedom to do this stuff. But what's the cost? What is the cost at work to have somebody constantly checking their 401k balance?
Yeah.
And looking, because the problem, and this is where we're talking to Arthur here.
Yeah, I think earlier this year, is 2025 when we're recording this, and we're recording it a little bit earlier than it's airing. I'm not sure exactly when you're listening, but I think earlier this year, Palantir lost 11.5% in one day, right? So if that's you and your 401k's in it, how productive was that day of work for you?
Right, but this is the Palantir story. The maximum drawdown was 85%, basically.
And define drawdown, because that might be unfamiliar language to some people.
So think peak to trough. So think Arthur takes his money and he takes $10,000. He's like, look, I have $10,000. It's kind of like when you're at the gas station and you're getting gas, and then on the radio it says, hey, the lottery is at $750 million. And you think, well, I don't usually carry cash, but I have a 20 sitting in the ashtray there. I'll just run in with that 20 and collect my $750 million. So you do, and you give it to the guy, and you're like, man, this is going to be amazing. And they announce the numbers, and they're like, nope, the pot is now at $900 million because no one won anything.
Right.
And so this is the same thing. So think So Arthur, you make this decision. It's January 28th of 21. You put your 10 grand in. It took until December 27 of 22 for that 10 grand to grow to 1,500. So think of basically 2 years of grinding results, and you're down from 10 grand down to 1,500. And so what are you going to do? And I'm going to just say, at some point you sold. You just sold. And I'm also going to say you didn't on December 27 of 2022 say, okay, 10,000 down to 1,500. I'm going to scrape up some money and find it anywhere I can and get it
more
invested so I can buy more of this.
I think there's a different. So yes, that's an actual drawdown of Palantir from just a couple of years ago. Tesla has had unbelievable drawdowns in its history, and the 74% during a similar time period. In 2022, the calendar year 2022, both of those stocks were down about 65%. Here's a more likely story. Now, we can say that because they've also had fabulous returns overall, but it has not been a smooth ride. And how the question was phrased is, this seems like a no-brainer. Can someone just tell me why I wouldn't do this? Well, because the same mojo that allows for these tremendous and fabulous returns that we've seen on the upside works the opposite as well, because they've had significant, alarming, like extreme volatility on the downside as well. So, Kevin, you're saying, well, what if you put it in and it happens to be a high point and it goes down? I think you're probably like, What if the opposite happens? You put it in and that 10,000 gets to 150,000. And then it goes from 150,000 back down to 20. Then you most certainly sold. If it goes from 10 to 1,500, you're probably like, okay, I guess, now how low can it go? Who really cares? But if it screams higher, and now you've got enough money, maybe not in the 10,000 example, now you have enough money to say, I might be able to retire. And so you retire, and then that stock craters, then what do? Likely that's when you sell. Likely that's when you have a hard time recovering and recovering from that. So, all right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group. I think that's probably more likely.
What's that?
You throw 100,000 in this, it turns into $1 million, and your shoulders are a little more broad, and then when that $1 million turns into 250. Then you panic.
Mm-hmm.
That's my guess.
That takes a level of emotional fortitude that most people don't have.
Right.
And because you've never been tested in that way before.
Okay, so here's, and I don't even know if we're allowed to talk about this, but here's bonus question number 1. 10 years from now, the fall of 2035, we will have robots in the background over there, like cleaning. Okay, what company is the leader? Apple, Microsoft, Tesla, or Nvidia? Which one would you say? Oh yeah, they've probably emerged through all this AI and humanoid robots and all this Jetson sort of stuff. Which Apple's still on top, Nvidia still on top, Tesla come back. What do you think?
I'd say Tesla.
Think so?
Because I don't know. I was having this conversation with one of my kids. Like, what is the next thing that will be like putting a desktop computer on everyone's desk at home? Mm-hmm. In every home, there's going to be a computer. Now there's multiple computers in every home.
Right, or one in your pocket, right? Which was the Apple story.
Is it outrageous to think that there will be some sort of robotics that become like an appliance in your house almost? Mm-hmm. It's just, everyone's got one. It helps. Whatever. I don't know.
I can't argue with that. It seems like they're the most diversified.
Yeah.
Right? I mean, you've got the self-driving cars, you've got the humanoid robots, you've got the Starlink, you've got Neuralink, right? Mm-hmm. And I have no idea if these will all split into different companies or not, but I think right now they're under an umbrella, and so they're the most diversified. So if hey, the future is going to have some wild changes, and I don't really know exactly how it's going to pan out, I could see Tesla just simply because it seems like they're doing the most R&D right now.
Yeah, I think. So it doesn't seem to me like Apple has innovated in the last 10 years.
Why didn't they buy OpenAI immediately?
Right. So if Apple hasn't innovated, NVIDIA, I'm not believing the NVIDIA story right now and the circular motion of the sales and everything else. I learned long ago not to bet against Microsoft.
Yeah.
And I don't think you would bet against Elon. But you got to tell me Elon is going to be in his right mind for the next 10 years.
And guys, so this I joked and said, I don't even know if we can talk about this. Well, why? No, this is not stock advice. We're not talking about the stock performance, because actually looking backwards, I would say give me Monster Energy, give me Domino's, and give me probably Bitcoin or something like that, right? That's outperformed just about anything. And so we're just talking about what companies are strong companies and leading companies out there in the future, not anything about stock performance or should you invest, because they obviously are each fantastic companies today. And so, all right, here we go. Anything more to pick up on the Palantir Tesla stuff? Pick that back up before we get into the next question?
Yeah, maybe just a little.
All right.
Yeah.
Here we go. If you have some dollars that you're going to need in the short term, but you need some return from them, you want them to provide some growth or some interest, some dividend. We know interest rates are coming down. What do? We're answering that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate that. The Wise Money Show on podcast. Nothing but questions from fans of the show today. And wrapping up a very intriguing one about, hey, I don't have a lot of money in my 401k. Why wouldn't I just take it out, pay the tax and penalty, and throw it all in Tesla and Palantir and just see how it goes? And the reason is those are extremely volatile. The same thing that has caused them to have fabulous returns, that volatility, it does work both ways. And there are tremendous times when they've had drawdowns like that you would not expect from the overall stock market. So to me, I would hold those within the basket of a lot of other diversification, right? So what else do you guys think, or what else would you suggest?
One of the things every investor has to just pause and do some reflecting, some introspective work at times. It's to kind of ask yourself, well, what are the emotions that are driving my investment decisions? Because sometimes it could be that we get into a situation where we're kind of counting on a Hail Mary pass in order to win the game that we're trying to win. Like, my retirement is riding on these investments exploding in value so that I can actually step away from work someday. We've talked to people who, in the last 2 years before they want to be able to retire, they take inventory and they say, you know what, I have a couple $100,000 saved and I need this to be $500,000. I need it to go from $200,000 to $500,000 in 2 years flat. And you say, well, boy, here's the risk. I remember Charlie Munger once saying, the famous, amazing investor, partner with Warren Buffett over at Berkshire Hathaway. He said once that impatience, for those who are impatient with their investments, time can be extremely damaging. But those who are patient, time is like your greatest ally. And, if you're hoping that a couple of high-flying stocks might take your kernels that should be like, this is my seed corn, this is what I'm going to get an entire crop out of, I need to just get it in the ground and working for me over time. If you're hoping that is going to just bring explosive growth, the risk is that you lose the capital that is the basis for all of your future success. And so even if it's a small balance, I would treat it like, hey, this is extremely valuable because this is what I'm going to build off of. This is the foundation that I'm going to try to build from. And so don't let yourself either get impatient or think that the small dollars don't matter, because that is what you build with. The goal is to start getting multiple compoundings and doublings happening, and that takes lots of time, not instant results.
Agreed.
Yeah, I found when I think about investing and the investing that I've tried, Mike, you said it's okay for everyone to have a little play money. And I think it probably is for you if you can learn, if you can be a fast learner, because with my play money, I've gone to the sure bets, right? So the sure bet is Palantir and Tesla, or whatever it is, fill in the blank. Based on investor psychology, the thing that feels like a sure bet today is not where you want to go. And where you want to go is the thing that no one wants. That's Warren Buffett, going back to him, says, hey, fear. It's ruled by fear and greed. When people are greedy, you should be fearful. And instead, this Arthur is saying, hey, everyone's greedy, and me too. I'm going to hop in and get this stuff. And
it's only natural.
Right. Yeah. And I think of this time idea, and my dad and his wife did the Great Loop. So they went through the Great Lakes and down to the Gulf of Mexico and back up and did this Great Loop. And he said, you know what the most dangerous thing to have on a boat is?
A clock?
A schedule.
Oh, yeah.
Because you get impatient and you say, hey, we've got to get there. And if we don't get there and I'd say probably a dangerous thing to have on an airplane too, a schedule.
Yeah.
And so
Count me out.
I know. So this is where it's like, no. If you can be patient, and to me, what are the superpowers in investing? Time. If you can be patient and use time and diversification.
Yeah.
So as tempting as it is to get rich quickly, I would try to figure out a way to get rich slowly. Even Arthur.
Yeah.
Yep.
And that leads right into this next question. Next question comes from the Wise Money webpage. There's a spot where you can submit a question right there on the right. And how do I make high dividends within a short term? Now, that's all the question. And you can read that a couple different ways. You could read it the same way. Hey, I need to double this money overnight. What are my options? Or you can look and say, well, interest rates are going down. Mortgage rates are still very high, but I'm seeing my high yield money market doesn't feel so high yield anymore. And I have a feeling, that's going to continue. How can I increase my dividends or my yield? Well, right now, and I actually think this is, there's a correlation here with this, that as more companies have, or more of the stock market is driven by tech companies that do a lot of research and development, that do a lot of share buybacks and other things, the dividend yield for the S&P 500 is now at the second lowest level it's ever been, ever. So it used to be I can buy a blue chip stock and get 4% interest in my dividend and have growth in my stock price. It's not around anymore. 1.2, I think it's the dividend yield, and it just depends on when you're listening to this, but not a high dividend yield. And you might say, wait, what? 1.2, I can get more than that in a high yield savings account. I know. There's not a lot of great options for dividend. Now, there are more advanced strategies out there using stock options or just focusing on dividend paying companies where you can get double the yield and in some cases triple that yield. Our equity income strategy is accomplishing that. But if you're just looking at a company, an individual stock, that company, let's say it has X amount of goodness. If it pays a dividend, it's going to pay out part of that goodness and retain the other part of that goodness for stock appreciation. So whether it's sort of like, I've heard the analogy, the goodness or the profits or the benefits from a company are the king size Snicker bar. And if you say, I want dividends, it doesn't mean, okay, we'll split it up into those minis or those fun size and give me the minis so I can eat a little along the way and still have the goodness be a king size candy bar. No. It's just you divvy it up and you'd have two fun size. Like it's still the same amount of candy bar. Mm-hmm. It's just some of it's getting paid out to you in a dividend. Right now, a lot is being used for share buybacks, which actually pushes the stock price higher because of the amount of shares outstanding. That gets a little technical. The short answer is there isn't an easy answer to the question.
The thing I like about dividends, though, is it reminds you that when you're investing in a stock, you are buying a piece of an actual business. And the business results, as they're providing great services or great products out in the economy that other people want or need, they're earning a profit and they have a thriving enterprise. And when you are profitable, that is the result of a well-run business. And to return a portion of those profits to the owners is just the reward of putting your capital at risk. Fewer and fewer stocks, though, or fewer and fewer companies are operating that way because they are just trying to keep on growing, and they're trying to provide value by just increasing the stock price.
I know, and then there's the moral hazard as well. If they pay out dividends, then the company is paying tax on those dollars, and then the shareholders are paying tax on those dollars. Mm-hmm. Versus instead of paying a dividend, if they buy back shares, well, then the company is paying tax on that money, but the shareholders are not because their stock value is just appreciating. Mm-hmm. So there's the short answer is if it's short-term money, you need to hold it in short-term instruments. And right now, those interest rates have been going down 3.5%, maybe 4% if you can find a CD special or some sort of special. That's the going rate right now. And that's quote-unquote high yield. So, all right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group.
I think helping share buybacks are, to me, it seems like such a sham.
I know. I don't like it, even though it almost sounded like I was proposing.
No, but it feels like such a sham. And the thing is, with if I have this profit, I have a choice. I can reinvest it in my company, or I can pay it out as a dividend, or I can buy my shares. And if I'm not reinvesting it in my company, it means I don't have a greater growth option than what I currently have.
But sometimes, the stock price can get artificially depressed and beaten up by the market, or it can just sort of fall out of favor. And if a board of directors has the ability to go buy a bargain, essentially, in their own shares, in some ways that signals, hey, we believe in this company because we know it's worth more than what it's selling for. So, yeah, we'll gobble up those benefits. But
if someone has $50 to save this month, where should it go? An extra $50. Where should it go? I know my answer. No one's going to be surprised. Roth IRA. I'll say it louder.
In Tesla stock?
No, just throw it in your Roth. Absolutely. I think
in a money market?
No, and a diversified allocation.
Tesla,
but I think
Palantir.
before I think what investment, I think where. And I did use my words intentionally in that question. Where would you put it? Not what would you invest in? And I think that does need to be the first answer, or the maybe the first answer is, well, before you decide where to put it, when do you need it back? Mm-hmm. And then after that, where should you put it? I think tax shelter first, and then what to invest in.
And are you already getting your full company match? And I mean, there's all kinds of questions that we would ask, but yeah, that could still be the Roth 401k if you haven't captured all of your employer match and everything.
Would you do HSA before Roth?
Depends.
Yeah. Yeah, I think you can buy Depends with your HSA. Someone fact check me on that.
Oh, dear.
All right, here we go. This next one is getting a little complicated. The answer is no, by the way, to this one.
To buying Depends?
Does the non-taxable portion of your Social Security count towards your modified adjusted gross income? So my guess is we get these next two questions in this segment, but I could be wrong. Last segment, land the plane. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go to YouTube, check it out, search the Wise Money Show, subscribe to it there, and then turn on notifications so you're made aware every time we drop new content. Not only this talk show is right there with bonus content in between the radio segments here, but also Next Wise Step videos air all throughout the work week right there, as well as reels or shorts or whatever your flavor is, we've got it, and all designed to bring helpful content to you from a financial planning perspective to help you take your next wise step in your financial life. So go to YouTube, search the Wise Money Show, subscribe to it there. Hitting questions from fans of the show. We've got two technical ones right here. Let's see if we can get through both of them. This is a call-in from a fan of the show, Brad. Thank you so much for the phase-out details for the new senior deduction. I've got a spreadsheet where I'm tracking my income for 2025, but mistakenly, I've been looking at my adjusted gross income instead of my modified adjusted gross income when looking at the phase-out amount. Here's my question. We pay tax on 85% of our Social Security payments, which is the maximum. The modified adjusted gross income calculation says to add non-taxable Social Security payments. Does that refer to the other 15%? I'm watching this and trying to figure out whether I should do a Roth conversion this year. So that's a fantastic question, Brad. And there's details and layers to this, because oftentimes when there are phase outs, when they say, here's a new tax benefit, like the increase in the state and local tax cap, the SALT cap, or the no tax on overtime, which isn't really true. There's like they throw that out there, but then there's some gotchas. And the primary gotcha is, well, if your income's too high. But the word income can mean a whole lot of different things. It rarely means wages. And it rarely means taxable income, which is your income after all deductions. Oftentimes, it's either adjusted gross income or modified adjusted gross income. And modified just means we'll start with your AGI and then add back a few things.
And aren't there just many different versions of the modified adjusted gross income? So it's like, depending on, are we talking about, in this case, the new senior deduction? Are we talking about Affordable Care Act issues, other deductions, other credits? Anywhere that you hear the phrase modified adjusted gross income, man, it seems like you've got to dig into the details to know, well, what is that calculation? And this is precisely why, man, it's hard to do tax planning on the back of a napkin.
Yeah.
And to just kind of spitball your way into, well, this is what you probably ought to be able to count on your tax return. I'm just a big believer that you need to be working with your certified financial planner and or a CPA who is, they're actually running these forecasts or tax projections in real software that is truly calculating all the nuanced stuff like a modified adjusted gross income for you, so you don't get a false sense of security like, oh, I think I'm eligible for this because here's what my income is. And you don't realize that, oh, you're not adding back those right items potentially.
Yeah.
Yeah, well, I mean, the other thing is with the new deductions that you're going to have if you're 65 or older, calculating those, because if you're single, it's $6,000. If you're married, it's $12,000. And you say, well, it's simple, right? If I get a $6,000 deduction, I'll pull $6,000 out of my IRA, and there's an offset. Well, it could be that simple, but it could not be that simple. Well, you might be pulling some of your Social Security over to pay taxes on that as well. So to Josh's point, figuring out how to calculate my tax projection, that is not simple.
All right. So what's the answer? We're waiting on the IRS to come out with their interpretation. So Congress sets the rules, the IRS interprets them. And they're not invited to the same parties that often. Like I'm going to say there's an adversarial relationship between the two. And I haven't seen in an official IRS, this is how we're defining modified adjusted gross income in this case. I am seeing a lot of people interpret it. And the majority of the sentiment that I'm seeing is that the non-taxable portion of your Social Security is not an add back for the modified adjusted gross income calculation for the new senior deduction. So Brad, you're seeing a source that it is. I can't state with authority that I've got an IRS publication right here that says it's not, but my hunch is right now that it's not. That would be an unusual. So the non-taxable portion of Social Security isn't a common add back for a modified adjusted gross income calculation.
Another question might be, do you have any tax-free interest on any of your, maybe you have some bonds that are paying out tax-exempt interest? Sometimes those get added back into these modified adjusted gross incomes. Again, some of these laws, the sweeping laws have been passed, but now the details have to roll out over time. And this is exactly why you have advisors in your life who can stay on top of this stuff and be watching and keeping you informed.
Yeah. So we should know more when the IRS does release their interpretation. That's probably going to be right at the end of the year or right before tax season. So it might not help a ton with Roth conversions, but unfortunately, it's not yet official from the IRS. Now, this weaves right into this is a technical one, but we're going to sneak it in here, and it has to do with this same thing where Congress set laws, and then the IRS, it took them years to interpret them, and this one has to do with the new 10-year rule with inheriting an IRA. So here's a question. My sibling passed away at 65, and the surviving sibling inherited their traditional IRA. They converted it to an inherited IRA. It's not a conversion. That's just a transfer from the original owner's IRA to the inherited IRA. Is there a way to convert to a Roth IRA instead if the sibling meets the less than 10-year age rule. Also, would their surviving sibling who's age 60 when their sibling passed away at 65 be able to withdraw the monies without taxes being withheld? The Secure Act 2.0 has me all confused. Thank you. Guys, can I just lead here?
Yeah, because you have to make that make sense.
Okay, so first thing, in the new, and this is saying Secure Act 2.0, in Secure Act 1.0, that's when this all changed, which was passed in late 2019, became effective 1/1 of 2020, had nothing to do with COVID. This was a huge amount of tax law changes, not connected to stimulus or anything. And it said if you are inheriting an IRA from someone, then or a pre-tax retirement account, the rules changed. You can no longer just withdraw a minimum amount out every single year throughout your entire life expectancy. You have to withdraw the account by the end of 10 years. That's it. So someone passed away in 2020, you've got to have the account emptied in 2030. That's basically what the law said. It took 3 years for the IRS to come up with an interpretation. It shocked everyone. It then took another 1.5 to 2 years for the IRS to get beat up by comments and then come up with a final interpretation. And so we just now have that interpretation starting. It was late 2024, but made effective in 2025. I'll gloss over a lot of that to speak to this question. The new law created 3 categories of beneficiaries. And one special category is called an eligible designated beneficiary. So eligible for unique rules, designated beneficiary. And one of those people, one of those classes in that category is someone that's less than 10 years younger than the original IRA owner. Well, they're eligible for something different. And that eligible means...
say that again, I'm sorry, because someone might not be able to interpret what you just said. Less than 10 years younger. In other words, someone closer in age to you within a 10-year band.
That's right. That's right. Thank you for specifying, because it's a tongue twister the way it's written. And it means they're eligible to not have to do the 10-year rule. They can make required withdrawals or small withdrawals over their lifetime. And so that's what you'd be able to do. You get to bypass the 10-year rule, take out a required distribution every year based on your own life expectancy and for the rest of your life, but you cannot convert it to a Roth IRA. It's still an inherited account. You cannot convert inherited IRAs to a Roth IRA, and it'd be your choice. It's taxable when you withdraw it. It's your choice whether you want to withhold taxes or not. So very confusing. We've done episodes on this. We've done a lot of content on it. I hope that helps. And I hope all of these questions and answers were helpful to you. If that's all the time we have for today, on behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.